If you're 54 or 55 right now, the next 3 years could save you, or cost you, hundreds of thousands of pounds in tax. And most people have absolutely no idea this is coming. I'm about to show you a perfect storm of pension rule changes that creates a massive planning opportunity, but only if you act before April 2028. Stay with me. This could be the most expensive 10 minutes you never watched. Let me introduce you to James. He's 54, owns 3 buy-to-let properties worth about £800,000, and has built up a pension pot of £1.2 million through years of higher rate tax relief. James thinks he's done well, and he has. But James doesn't know about 2 rule changes that are about to collide in the worst possible way for people exactly like him. First, from April 2027, unused pension funds will be dragged into your estate for inheritance tax purposes. That's less than 2 years away. Second, from April 2028, the minimum pension age rises from 55 to 57. Now, if you're thinking, so what, I'll just wait until 57, that could be the most expensive decision you ever make. Here's why. Right now, if you're 55 or over, you can access your pension. You can take 25% as a tax-free lump sum. That's up to £268,275, completely tax-free. And then either take the rest as income, or leave it invested for later. And here's the really powerful bit: if you die before age 75, your entire remaining pension pot passes to your beneficiaries completely tax-free. No income tax, no inheritance tax. Nothing. Even if you die after 75, there's no inheritance tax on pensions. Your beneficiaries just pay income tax when they draw the money out. Meanwhile, for inheritance tax on everything else, you get a nil rate band of £325,000, plus potentially another £175,000 if you're leaving your main residence to children or grandchildren. So a couple can potentially pass on £1 million before paying the 40% inheritance tax rate. But here's what changes in April 2027, and this came completely out of left field in the 2024 autumn budget. From April 6, 2027, unused pension funds will be included in your estate for inheritance tax purposes, regardless of whether you die before or after age 75. Let's go back to James. His total wealth is roughly £2 million. 1.2 million in pensions, 800,000 in property. Under current rules, if James died tomorrow, his pension would pass tax-free to his children. They'd only pay inheritance tax on the property portion above the nil rate bands. But from April 2027, that 1.2 million pension gets added to his estate. Now we're looking at a £2 million estate. After nil rate bands, that's potentially 1.35 million subject to 40% inheritance tax. That's £460,000 going straight to HMRC. And remember, this applies whether you die at 65, 75, or 95. Age doesn't matter anymore. Now layer on the second change. From April 6, 2028, you can't access your pension until age 57 unless you have a protected pension age from certain schemes. So if you're currently 54, you've got until you turn 55 to start accessing your pension before the window closes for 2 years. Miss that window, and you're stuck watching your pension get dragged into your estate for inheritance tax purposes while being unable to do anything about it. This creates an incredibly narrow planning window. You need to be 55 before April 2028 to maintain access. But you also need to act before April 2027 when the inheritance tax rules change. If you're 54 now, you might have as little as 18 months to implement a strategy. If you're 53, you're already too late for the optimal approach unless you have protected pension age rights. So what can James do? He's got several strategies, and the key is starting before April 2027. Strategy 1, take the tax-free lump sum. James can take 25% of his 1.2 million pension tax-free. That's £300,000, though it's capped at £268,275. This comes straight out of his estate. Every pound he takes out is a pound less subject to 40% inheritance tax. Strategy 2, start flexible drawdown. Once James takes his tax-free lump sum, he can start drawing income from the remaining pot. Yes, he'll pay income tax on withdrawals, but here's the key calculation. If James is a higher rate taxpayer at 40%, he pays 40% income tax on pension withdrawals. But if he leaves the money in the pension from April 2027 onwards, his beneficiaries will pay 40% inheritance tax and income tax when they eventually draw it. That's potentially an effective rate of 64%. Strategy 3. Use excess income planning. If James draws more from his pension than he needs to live on, he can potentially gift the excess to family members. Gifts from income are immediately exempt from inheritance tax if they don't affect your standard of living. The key insight: taking money out of your pension and paying 40% income tax might be cheaper than leaving it in and paying 40% inheritance tax plus income tax later. Let's run the numbers for James. Scenario 1, he does nothing. James dies in 2030 with his full £1.2 million pension still intact. His estate is $2 million total. After nil rate bans of around $650,000 for a married couple, that's $1.35 million subject to 40% inheritance tax. Tax bill, £540,000. When his children eventually draw the pension, they'll pay income tax on top. If they're higher rate taxpayers, that's another $480,000 in income tax. Total tax, over £1 million. Scenario 2, James acts now. Between now and April 2027, he takes his full tax-free lump sum of £268,275. Then he draws an additional $100,000 per year for 2 years as income. That's another $200,000 out of the pot. He's now removed $468,275 from his pension, paying around $80,000 in income tax on the $200,000 drawn as income. His remaining pension pot is now around $732,000 instead of $1.2 million. His total estate for inheritance tax is about $1.53 million instead of $2 million. After nil rate bans, inheritance tax is roughly $350,000 instead of $540,000. He's saved nearly £200,000 in inheritance tax, even after paying $80,000 in income tax. Net saving, £120,000. And that's a conservative example. The savings get bigger with larger pension pots. Now, this isn't financial advice, and there are some important caveats. First, this strategy works best if you can afford to live on less income or have other assets to support your lifestyle. Second, if you're married, you need to consider spousal exemptions. Assets passing between spouses are generally exempt from inheritance tax, which changes the calculation. Third, the residence nil rate ban starts to taper away once your estate exceeds $2 million, so the math changes for very wealthy individuals. Fourth, some pension schemes have protected minimum pension ages that let you access benefits before the general minimum age rises. Check with your scheme first. And finally, pension rules change. A lot. We've seen 3 major changes in the last 5 years alone. Future governments might reverse some of these rules, but you can't plan based on what might happen. You can only plan based on what definitely will happen. What we know for certain is that April 2027 and April 2028 are locked in. The window for this planning opportunity is closing fast. If you found this useful, subscribe for more pension and tax planning insights. Drop a comment below if you're in this age bracket. I'd love to hear about your planning strategies. And remember, this is general information only. For your specific situation, always consult with a qualified financial advisor who can look at your complete picture. The clock is ticking. Don't let this opportunity slip away.